You know that's not straight.
Hi everyone, welcome to the Q&A Monday today. Today very exciting. We're gonna have Aidan back as well.
Yeah.
So because over the past few weeks, there are lots of people asking if you have cash in the business. So if you are running a very profitable business or like certain type of business like consultants, it's very likely that you have quite a lot of cash in the business. Quite often you get advice saying if you take too much dividends or too high salary, you get taxed. So it ends up either you have a pile of cash in the business, you don't know what to do with it, or if you need the cash and then what to do. So today we're going to have Aidan. We're going to talk about different strategies. Later on there will be two parts. The first part is what to do if you don't want to extract. If you just want to take the minimum amount each month and for your living and leave the rest in the business, or if you want to extract more and then put in your personal investments, then we can talk about both. Okay, so I think some of my audience already know Aidan, but I'm sure most of them haven't met Aidan. So Aidan, just briefly introduce yourself.
Thank you, Hannah. My name is Aidan Dow. I run Aidan Dow Wealth Management, and I help individuals with all types of investing and financial planning. And looking forward to today's chat.
Okay,
Yeah.
Good. Very good. Yeah, because like Aidan's doing this financial advice is actually working very closely to what I do. So that's quite often there will be some interesting discussion.
Exactly.
Yeah.
Yeah.
Okay, so today we're talking about what to do when you have lots of cash in the business. So, of course, in the past, I've been talking to clients, say, what's your extraction strategy? There are people, for day-to-day living.
Yes.
Because we do need cash for
Exactly,
living.
we do. We all need that.
Yeah,
Yes, yeah.
but then we don't need that much unless something happens. And of course, for some consultancy business, you might just say that the cash is there. You don't need because you have very low overheads.
Yes.
Some businesses, you might want to keep there just in case something happens.
Yeah.
So shall we just start with what to do if you want to keep the cash in the company? So what can people do about it?
Well, some people may or may not know, but if you've got a company, there's nothing to stop your company having investments, so opening investment accounts on behalf of your company. So, for example, your exceptional consultancy could have an investment account, and you could put a portion of your cash into long-term investments. The key thing there is to really know how long you think you can tie the money up. If you're looking at using that money within 3 to 5 years, then I wouldn't. Before 3 to 5 years, then I wouldn't recommend having an investment account and taking stock market risk. But if you've got money that's sitting there, you haven't got a good strategy on it, taking out of the business, want to keep it in the business as a sort of emergency, but you know that you could tie the money up for upwards of 5 years, then there's nothing to stop you, and it's a good strategy to have an investment account for the business. So it's separate to your own name, taxed separately to your own name. So that's what many people do. The problem comes when the investments start generating more than your revenue from generating the business, and that's the revenue doesn't like that. But obviously that's a long way away for most of your clients who are in a situation where they've got healthy companies getting good income coming in. Then an investment company would just supplement that income. It wouldn't really surpass the income of what people are generating from their business.
Yeah, that's very interesting.
Yeah.
So of course that can be a very good strategy.
It's a good strategy, and also you can have your own risk profile. So each individual's got their own risk profile, but you can have a lower risk or a higher risk profile for your company investment accounts, and it doesn't have to be the same as your individual investment, because the timescales are very often very different.
Yeah, that's true. I suppose if you are in that situation, you need to know what's your objective.
Correct. Yeah,
so how much cash you need for short term.
Yes.
But if you don't need that for a while, and then that can be the good option.
Well, that's right. Yeah, with interest rates so low, if you're just sitting on a lot of cash within the business, keeping it in the bank, then effectively over 2 to 3 years, that money is going backwards. Whereas if you can afford to tie it up for 3, 4, 5 years, take some investment risk, then that money will keep pace with inflation, and that keeps your business healthy, and you've got it there to draw upon when you've got leaner years from the business. You can take it out, or take it out in a more tax efficient way when you feel appropriate.
Yeah, that's true. So in the meantime, you have this account in the business.
Yes.
But in the meantime, you can still extract the money like gradually, slowly within the basic rate band,
yes.
so you don't get taxed that much. Yeah. So that sounds like one of the good strategies.
That's a very good strategy. Yes.
Yeah.
Not everybody knows about it, but it's worth talking about it. It's quite a distinction of your own investments and your company investments.
Yeah, exactly. So, of course, there are also, there are standard way of looking at this, like what to do with a company cash. I've seen also there are lots of, risky ways.
Yes.
So is this very risky, or what's the drawback of it?
Well, the nice thing about this is because you're in control of the company's money, you can control how much risk you take with the investments. You're not restricted within the company regulations to be fixed to a low risk or a high risk. You can pick your risk within that. So you've got the flexibility of having it towards the low risk side, down towards cash, or bring in some risk in there with maybe some equity exposure, and take as much risk as you like.
Yeah, that's true. Okay.
I mean, the key thing there is setting the objectives, knowing when you will need the money. There's no point in putting it into risk investments, and a year or 2 years later you need that money out. The stock market may have dropped, so it's always crucial that you monitor when you'll need the money, how much risk you want to take with that money, what's the worst case scenario for that investment, and how would that affect the running of your business over the longer term.
Yeah, exactly. I think the business, it's also a little bit like individual. It's better you have a little bit of variety as well.
Exactly. Yeah. Good point.
So of course you might think some cash you need for short term and some cash you don't need for a while. And there's another strategy which can be one option.
Yes.
So that is the company pension contribution.
Yep.
So
yes.
How do you compare both?
Yes, so that's another interesting route. So you can, the company can make pension contributions to the individual, which is an interesting way because it means that the individual is getting better remuneration. Okay, it's still delayed because you can't access it until you reach retirement age, but it's tax efficient for the company because the company doesn't pay national insurance on the pension contribution. So if you're just paying yourself more, or the company's paying individuals more, then the company will have to pay national insurance on the salary payments it makes. Yeah. If the company pays into a pension on behalf of the individuals, in some ways it feels like a salary because it's a benefit, if you like, a benefit, but the company doesn't pay national insurance on that contribution. So again, it's efficient as well for the company and for the individual. So
yeah, exactly. So it's like you can have a variety of different things.
Yes.
Yeah, and of course pension contribution, that's one of the tax deductions for your company tax.
Yes.
Yeah. And also I think we can have a very a variety of strategy, really see what you need, especially if you have a kids at home. You can also utilize it's ending very soon, but there will be employer supported childcare, which you can take advantage of. So that can be another option.
Yeah.
So there are loads of options without getting into some high risk tax avoidance trust. So there are loads of options out there. Yeah. So apart from this, in a bit we'll go into the different strategy, which is extracting the cash and then invest that cash. So before we go into that, do you have any thoughts around cash in the company?
Yeah, I think the key thing is that absolutely and utterly know how much cash the company needs for running costs for 3 to 4 years before you consider tying up any company cash in investments. And I think the key thing as well is understanding risk and understanding your own risk profile and how the company risk profile may be different from your own risk profile, because they're two different entities. And although you have a risk profile that may be saving for the long term, 20, 30 years, the business may have a different risk profile of maybe only saving for 4 or 5 years. And that that alters the investment profile quite dramatically, these two different timescales. So it's crucial to understand that.
Yeah, exactly. Okay, let's see if anyone have any questions. I don't think so, because I have another device here. So just if I look down, because sometimes I cannot see the comments, but then I can see it from my iPad. But I don't think it's anyone have any questions. But if you do, even later on we'll go into the different strategy. If you do have any questions on cash in the company, be free to type in the comments. Okay, so let's go into the second part.
Certainly.
Yeah, what if someone decide they want to take more salary or take more dividends?
Yes.
And of course, it trigger higher tax and national insurance.
Yep.
So what can they do? Because I know there are very generous tax breaks here.
There are, yes.
Yeah, one of them is a VCT. Yeah. So in one of our previous episodes, we have had a very detailed discussion on VCT, but perhaps let's just have a bit recap.
Certainly.
Yeah. Okay.
So a VCT stands for Venture Capital Trust. It's a government scheme to encourage investment in smaller companies and startup companies, because they employ a huge number of people within the UK. So the government offers really good tax breaks for people taking risk and investing in these companies. So most people start to consider them once they've used up their ISA allowance and their pension contributions. Then they think, where else can I look for pension, for tax savings, tax efficiency? So venture capital trusts are one of those areas. They've been running for about 20 years, and basically, very quick summary, what happens is any money you put into a venture capital trust, you get tax relief on. Yeah. So therefore, if you invest £1, you get 30% tax relief on that pound. So you invest £1, you invest 70p, and £1 gets invested on your behalf. Then what happens is, throughout the life of that VCT, you will get a dividend payment, and that dividend payment will be tax-free. So tax relief as you go in, 30%, and then ongoing for the 6-7 years that the VCTs run, you get a tax-free income, and that varies depending upon the VCT vehicle that you go into. So that's it. Typically, they're a collection of maybe up to 20 or 30 individual startup or venture type companies, and they can offer terrific growth, and also they can offer diversity, because you can't really access this area of the market through the normal stock markets. So the key things to consider are they are higher risk investments. Don't invest in them purely for the tax relief. You've got to really think, is this appropriate for me? How I monitor it for my clients is I'll make sure that if they're investing in VCTs, they understand the risks, and that it is a maximum of 10% of the overall wealth is invested in a VCT, because they are high risk, and you've got to have that appetite for risk. You've got to have that ability to not access the capital for 6 years. I mean, really, it's completely illiquid. You put money in, and you really have got to say goodbye to that money for 6 years. So it's and you can't change the risk profile within that 6 years, unlike a pension, where you can invest. You can go stay in cash in the pension while you're nervous about the market. With a VCT, you're committed. You can't change the investment profile, and you're in for that long term, six years. Yeah, that's true. Because lots of people, they are interested for the first instance was because of the tax relief. That's right. And there's an expression in the investing world: don't let the tax tail wag the dog. So you've heard that expression? That's an accounting one as well.
Exactly. Yeah, we always talk about don't try to do something for the sake of saving tax only.
Yes.
You got to prioritize your overall strategy, like overall investment strategy or wealth growth strategy. These are the most important thing. But the tax relief or anything like that's secondary.
Very much so. Yeah, just to labour the point there on the risk. Basically, VCTs are for higher risk investors. There's not when the majority of my clients are not higher risk investors. The most investors come out around medium to high risk investors. VCTs are for higher risk investors. Yeah, so it's worth bearing that in mind.
Yeah, exactly. So when it comes to the the risks,
yes,
because like from last video I did send to some people,
yep.
when they look at it, they think it's too risky.
Yep.
If that's something like if someone is really conservative,
yes.
Is that something not really for them?
Well, it's something to look at and something to consider. Now, if we looked at venture companies across the board, the default rate on these companies failing is quite high. It's up around 40%. A venture capital trust is a fund of different venture companies. So there's a fund manager sitting over that, picking the best investments for their venture capital trust. Now, typically what they do, they'll meet 1,000 different companies, and they'll invest only each year in 6. So by that whittling down process, that does help reduce some of the risk. Also, what they'll do is they'll pay out to these venture companies capital. They'll drip the capital into the companies. So over the period of 6 years, they'll give a small amount in year 1, more in year 2, more in year 3. So what happens is the companies that aren't doing so well don't get very much of the money because they do fail within 2 or 3 years. So they've only had a small amount of money from the venture capital managers. And then it's the ones that do well that get more money and take up more of the money. So what happens there is the default rate drops within the good funds. It drops from 40% way down to 14%.
Okay.
Failure within the company. So that really helps. Also, venture capital fund managers are they are real experts. They come from the creme de la creme of the investment world. Very often they're come from a private equity background. And what happens is some of the venture capital trusts, the venture capital managers will take a board position with the companies that they're investing in. So they've got a really, really good feel of what's happening, any problems, and I can help build that growth within the thing. So yes, they are risky, but there are ways that you can, if you know the venture capital trust you're investing well, that you can the managers can help reduce that risk by filtering the number of companies, taking board positions, and really getting to get under the skin of the investments they're making. Plus, you're not just making one; it's a collection of maybe 20 or 30 different venture companies, which does take an element of the risk out. But I think the key thing is understanding what you're investing in, understanding the risks, and understanding the fact that you can't get access to that capital for the whole time you're invested. The 6 years, and 6 years is a long time. A lot can happen in 6 years. If there's any chance that you'll need access to those funds within 6 years, it's really not for you. It's really,
Yeah, exactly. Yeah. I think it's the same as a company. For individual yourself, you also need to know how much money you need for the short term, and how much money you want to invest to maximize this sort of tax relief. And the other thing for individual, you can again make pension contribution for yourself.
Yes,
that is also the tax relief.
Yep.
Yeah. So as we know, like VCT can be very risky for some people.
Yeah.
So just talk about pension. What would be like? Is that something suitable for people who are more conservative?
Yeah, that's a good question, and I'll probably jump back there. The first thing to consider is pension contributions because they are very, very tax efficient.
Yeah.
VCTs are more once you've used up your pension pot, and you want a little bit of extra growth. So just recapping on the advantages of an individual making pension contributions is, first of all, you get tax relief, which is terrific, and then you get the choice once you put the money into your pension. You can play around with the risk level you're taking within that pension, which is positive. I mean, you're not locked into high risk when you feel that maybe the time is right for a bit of low risk. So so you've got flexibility. You could put money into the pension, get the tax relief, and you could leave it in cash if you wanted it. Or you could have it fully exposed to high risk investments. So you've got although you don't have access to the money, you've got access to the risk within the pension. So So that's slightly different from VCTs, whereas you're committed, you can't change, you can't select how risky you want to be within the VCT. With a pension, you can make the pension contribution, get tax relief, and then either you can monitor that risk or outsource it to somebody, an expert to monitor that risk, and you can give them the mandate to be, I want that to be very risky, or you want that to be not so risky, or somewhere in the middle. So it's a subtle difference, but it is worth understanding. But I'd always say pension contributions first, and then VCT contributions after that, if it's within your risk profile.
Exactly. So it's really, you need to know your objective as well as an individual.
Very much so.
That's really interesting. I think for individual, again, I think that's also beneficial for people who are earning over 100K, or like people who are self-employed.
Yes.
For some reason or some restriction, they cannot operate under the limited company structure. So they can take advantage of these options.
That's right.
But again, I suppose you cannot just decide I want to do this tomorrow and you do it. Do seek for professional advice.
Is it worth recapping what we mean by tax relief? So tax relief, basically, you earn anything over £11,000, you'll pay 20% tax on that, right up to about 35. Is that right, or 40?
This year is 45.
45, yes. So and then once you start earning over 45,000, you will be paying 40% tax. So if you're in that bracket or earning over 11,000, anything you contribute into a pension, so you put £100 into a pension, then the government will say, well, thank you for making that pension contribution. We'll give you £100 worth of tax back. Now, if you're a basic rate taxpayer, that will be £20. If you're a higher rate taxpayer, that will be £140. So it's you can see the advantage of tax relief. You invest £1, you get £1.40 invested. That's 40% overnight, which no fund manager can really deliver those sort of returns. So pension contributions are really terrific if you've got any scope or any scope or time to make those contributions. It's worth doing.
Exactly.
Okay,
that's very interesting for today. I hope you all get value from it. So let me just see if any questions for now. No. Okay, you guys have been really nice audience for today. But again, if you do have anything later on, especially when you are watching replay, because later on we'll get our links, our business links underneath. So you can either connect with me. If you haven't been in my group yet, be free to request to join, because when you join my group, you can not just connect with me, you can also connect with Aiden. Although you will see I do most of the talking in the group. Okay, so just before we wrap up, for the second part of strategy, like extracting cash and then mitigate the tax in a different way. So is there any final thoughts on that?
Final thought, it's complex stuff, so definitely speak to Hannah or speak to me. There really is complex stuff, but there's a lot you can do. There really is a lot you can do. And these are all things that are completely legitimate. The government schemes, so it's completely, there's so much you can do and get yourself great returns without really taking very much risk. So.
Yeah, exactly. And also, just one quick note, because I work with lots of medical professionals.
Yes.
Nowadays, a lot of them, they are operating within the IR35.
Right.
So they lose that sort of a tax relief. But if you are caught by IR35, the second part of strategy, this pension contribution as well as VCT, these are things you can potentially consider to help you to mitigate the tax. So that's something you can do. So I think we had a good discussion for today, especially if later on you get some advice saying, just take this much money, take low salary and high dividends, that's it, and you're not yet convinced, and be free to come watch this video and speak to Aiden to see any other exotic way to use that cash. Okay, so just finally, if people, of course, you will be in my group.
Yes.
But if people want to know more about you,
yes,
want to check you out, what's the best way to connect with you?
Well, the best way, I've got a website, aidendowwealthmanagement.com. I've also got a Facebook page, Aiden Dow Wealth Management. So yeah, either of those ways are very efficient. My email addresses are on there. So yeah, I'd be delighted to help anybody with any questions, even if it's a second opinion on existing things you've got in place. But yeah, I'd strongly advise speaking to, if it's not me, somebody to help you, because it's very complex stuff. But there's lots of opportunities out there.
Yeah, exactly. Okay, so thank you everyone for watching. If you're watching replay, thank you for watching replay. And have a wonderful evening.
Yes,
and anything else?
That's it. No, thanks for tuning in. Yeah, excellent. Thanks.
Okay, thank you very much, and have a nice evening. Bye.
Bye.